last class, we have used we have discussed about the different sources of long-term funds, that is shares, debentures, retained earnings, and so on. We have also discussed about the different types of shares, different types of debentures. So in today's class, we'll be discussing about one more source of finance, that is we call as short-term source of finance. So we'll go in detail about it. So short term, what is short term? Short term finance will tell you that funds which we are reading for a short period, that is less than 1 year. Okay, so we'll just revisit the financial decisions. So financial decisions are divided into three types: investment, asset management, and financing. So financing decision includes two types of finance, that is short term and long term, and international financing. So we'll move on to the first type of short-term finance, which is called as spontaneous financing. Now, what is spontaneous? Spontaneous means it is an attempt where you need funds on an impulse, say for buying raw materials or paying certain bills. So there are two main characteristics of spontaneous financing. There is no additional attempt made for or negotiation made. So like for example, when you go for a long-term loan, a mortgage loan. Now what is mortgage loan? Mortgage loan, you are keeping something as a security, keeping a mortgage and then taking a loan, or you are taking some other type of a loan. That time you have to go through different banks, you have to make a deal with them, give necessary papers. The negotiations, the meetings are lengthy, and it is not immediately that you get the finance. Okay, so here in spontaneous finance, as the money amount is smaller and it is needed for day-to-day items, it is dependent upon how good your business is, how cordial your relations are with your suppliers. So there is not formal negotiations required. Then the second important characteristic is it is a result of company's routine operations. I want to buy raw materials, I have to pay the wages, and then I have to pay some bills and so on. We have two sources of spontaneous finance. One is trade credit, another is accruals. Accruals are also called as um, outstanding or open account transactions. Now, what is trade credit? So, credit allowed by one business to another. Say, for example, you are buying raw material. You have a restaurant, as you are from hospitality sector, you have a restaurant and you are buying groceries, oil, vegetables, fruits from somebody. So as is yours is a restaurant, the vendor from whom you are buying gives you a month credit, means at the end of every month you will pay that amount. Okay, so you are buying, not paying then and there, you're paying maybe 1 month later or 45 days later. So such type of finance is called as trade credits. And in this we have three types: open account arrangement, note payables, and trade expenses acceptance. Okay, so it is merely a simple credit given you. Say if you're a student, you're having lunch at a mess. So every end of the month you are paying. So this is a simple kind of credit, but this is not business to business. It is a personal account with a business. So similarly, if you have a business, small business, and another small business is giving you a credit, it is called as trade credit. So we'll discuss about what is open account arrangements. So open account arrangements, here you are using invoicing, but no additional security payment is required. Means you are giving them a bill that on this day you have to pay me so much, or this is your bill, so much amount you have borrowed from me. So there is just an invoice or a bill, but you are not keeping anything as a security. You're not giving any mortgage. There is no even a contract also. Okay, arrangement is where sales are made with no formal debt contract. Say, for example, when you take a loan, you have a document, a contract specifying the amount, the installments to be paid, the interest details, and so on. But here it is basically because of the long standing relationship between that one business to another. Say you are his old customer or he is your old customer. So because of the cordial relations, long lasting, trustworthy business partners, that credit is given. So you don't need a debt contract, only you need an invoice or a bill. So, and that too, even if you are having that person or that businessman knows you for a long time, it is based on how well you have paid before. Say in past few attempts, you didn't pay the amount correctly at the end of the month. Okay, you were saying, come tomorrow, I will give you next month. If such things are there, credit worthiness means you're not paying in time. That time, this will not happen because it is about small money for small amount and between small businessmen. So they can't postpone payment of debt and give you loan again and again. So we have certain terms of sale here. So we call them as COD, that is cash on delivery. Here we don't have any credit. As and when you buy the product, you have to, as and when you buy and receive the product, you have to pay the amount. So here COD or CBD, then and there a payment is made. There is no risk that I have to ask him come later 1 month. No. Okay. So this is used not in business nowadays, but means we not business B2B, but it is between B2C. Then net period or no discount. When credit is extended, the seller specifies the period of time allowed for payment. Okay, so net period means without discount, you are saying pay me after 30 days. So if I say net 30, it means that after 30, you have to pay me. After 30 of what? 30 days of the invoice date or the bill date or the date of your taking the delivery. So net 30 means without any discount, after 30 days of the bill date, you have to pay the amount. So this is called as net period without discount. Then we have net period with discount, that is cash discount. So when credit is extended, the seller specifies the period of time within which you can avail discount. Okay, say for example, if it is written 2/10 net 30, it means that if you pay within 10 days of your invoice date, you will get a 2% discount on your invoice price or your bill amount. But otherwise, without discount, you can pay up to 30 days. So if you want some discount, you have to pay within 10 days. So this system is there so that your creditor, so that your debtor will pay you early. Okay, so if I show you an attraction of discount, you will definitely pay earlier. So 2/10 net 30 means pay within 10 days and get a discount of 2%. If not paid in 10 days, up to 30 days you can pay, but you will not get any discount. Next is seasonal dating. So seasonal dating means these are the credit terms that encourage the buyer of seasonal products to take delivery before peak sales and defer the payment until the peak sales are over. Means so some products have seasonal demand. So he's telling you can book your order and take it the delivery before there is high demand or there are high sales. So you take early delivery and pay up to the time where sales are high. Then next one is stretching account payables. So postponing payments beyond the due date is called as stretching accounts payable. So I had given you 30 days time, but still then you want some extra time. So late payment penalties or interest will happen if you are giving extra time to the debtor to pay. Now, who is a debtor? A person who has bought products from you and not paid. So you are a creditor and the person who has bought from you without paying is a debtor. So sometimes what happens is even after the due date, after giving the 30 days or whatever it is, they stretch it. But it is not too bad if stretching is due to seasonal or cyclical factors. But in general, if you are making a habit of stretching the payments, means you're getting extra time, then it will be difficult for the creditor. And so he will have to have some penalty or interest. Then also your credit rating, or next time that creditor will think about it to give you more time for payment. Then third one in spontaneous or trade credit is notes payable. Now what is note payable? This is a document wherein say you are saying net 30. So the debtor is saying that he'll pay after 30 days. But say for example, if you want money at the 10th or 15th day, but the debtor is not paying you, what you can do is you can make a document which is called as a bills payable, and you can transfer it to somebody else. Means you will sell that invoice, but you have to take the consent from the debtor that that person A has sold to B and B is going to pay after 30 days. But A can't wait up to 30 days. So A is selling that document to a bank or to a third party and saying that after 30 days, B will pay to you. But now you pay me. But this payment is made with some commission deducted. So if that person B has to pay you 10,000, the bank will pay you 9,800, something like that, because the 200 rupees is the interest or remuneration for him waiting for 15 days. So you are getting your amount then and there. He will wait for some more time until the due date of that bill will there. So such documents are called as notes payable, where a debtor or a creditor can transfer that document and get instant amount. So legally it stands somewhere between a IOU document and a bank loan. Now, what is an IOU document? IOU document is a document where you write that I have to pay you a certain amount on a certain date. Here, this is you are transferring it to a third party. So it is neither a bank loan, neither a IOU. So it is something in between. So seller may require a formal procedure. So the bills payable has a particular format. It should have the name of the person who is drawing it, the name of the person whom it is transferred, who has to pay, the amount, address, signature, and even a stamp. Okay, so this is all about spontaneous financing. Other types of short-term credits we will study in our next class. So thank you. Any doubts you can please raise and comment, if so that I can understand whether you have understood or not. If any queries, I will solve it in our next session. So that's all for today. Thank you. Bye.